The pound was emerging as one of the worst performing major currencies in the world after it was reported that Rachel Reeves is looking to scrap plans to hike income tax. UK gilts also sank as cost of borrowing inched up. The decision, driven by better UK GDP forecasts, was reported to the Office for Budget Responsibility. The Treasury could still be cutting the thresholds at which people start paying different rates of income tax alongside other smaller measures. According to the Institute for Fiscal Studies, if Rachel Reeves freezes the personal tax threshold for a further 2 years, 1 in 4 employees in England and Wales will be higher rate taxpayers by the end of the decade. The current thresholds at which the 20% basic rate, 40% higher rate, and top 45% rate of income tax start to apply have been frozen in cash terms since 2021. Rather than rising with inflation, thresholds for national insurance contributions have also been unchanged since 2023. Earlier in the month, in a rare pre-budget speech, Rachel Reeves hinted on the need for tough choices seen as preparing the ground for income tax rises. We replay a clip of her speech.
The continual threat of tariffs has dragged on global confidence, deterring business investment and dampening growth. Inflation has been too slow to come down, as supply chains continue to be volatile, meaning the costs of everyday essentials remain too high, and the cost of government borrowing has increased around the world, a shift that Britain, with our high levels of debt left by the previous government, has been particularly exposed to. And in an uncertain world, we also face pressure to increase our defence spending, and it is right that we do that, protecting ourselves from hostile actors and supporting our allies. The Prime Minister, the Secretary of Work and Pensions, and this whole government are committed to reforming our welfare state, so that it is not a system that counts the costs of failure, but one that invests in success and protects those who need it most. But it is already clear that the productivity performance that we inherited from the last government is weaker than previously thought. A less productive economy is one that produces less output per hour worked. That has consequences for working people, for their jobs, and for their wages. And it has consequences for the public finances too, in lower tax receipts. Poor productivity means that we're putting in more, but getting out less. The chronic stop-go cycle of public investment has left us with roads full of potholes, high energy prices, and unstable conditions for vital business investment in skills and technology. And long-term failure to invest in our regions has built growth on a narrow base, with some parts of the country forging ahead, while others fall behind. This isn't about relitigating old choices. It's about being honest with the people about the consequences that those choices have had. It is my job to deal with the world as we find it, not the world that I might wish it to be. Not to commentate or to speculate, but to act. In my Maze lecture last year, I set out our plan for solving our productivity problem through a programme of stability, investment and reform. And when I became Chancellor, I began to put that plan into action, stabilising our public finances, making the tax and spending decisions to get debt down and to fund our public services sustainably, changing the fiscal rules to increase public investment by £120 billion over the course of this Parliament, and crowding in private investment too, for road and for rail, for housing and nuclear power, and reforming our economy, ripping up the planning rules so we can build housing and infrastructure right across the country, bringing the brightest and the best to our shores with a new visa regime. Inflation is already much lower than the double digits seen under the previous government. And the choices I make in this budget this month will be focused on getting inflation falling and creating the conditions for interest rate cuts to support economic growth and improve the cost of living. I understand the urge for easy answers. But politicians of recent years have become addicted to shelling out for short-term sticking plaster solutions rather than making long-term economic plans. They were irresponsible then. And those who continue to push for easy answers are irresponsible now. The UK's national debt now stands at £2.6 trillion, equivalent to 94% of GDP.
As the uncertainty revs up around the UK autumn budget to be read later in the month, speculations are rife that the Labour Party may be looking for new leadership as Starmer comes under fresh pressures and polls show waning popularity. To make matters worse for the Prime Minister, UK economic output unexpectedly shrank in September, dragging down Q3 GDP growth and confirming the fragile state of the economy ahead of Rachel Reeves' budget. GDP contracted by 0.1% in September from the previous month, also less than predictions of 0% growth. Hello, this is Global Business Insight, where we dive into the headlines and bring perspectives to support understanding of the context that we find ourselves in, especially for business. As part of a trade deal signed last month, South Korea is investing $350 billion in America, including $150 billion in its shipbuilding industry. In a joint statement showing details of the agreement, America also granted South Korea permission to build nuclear-powered submarines. Although the government shutdown is over, the lingering data fog, which could derail Federal Reserve rate cuts, may be driving caution and a sell-off, especially for the more rate-sensitive NASDAQ. The US tech-heavy NASDAQ index sank 2.3% yesterday, weighed down by the falling value of major tech stocks like AI chipmaker NVIDIA, down by 3.6%. CoreWeave, that's a data center operator, also saw its shares sink as much as 8.3%. For China, the effect of a trade war with the US and weak domestic demand could be telling on growth. China's Statistics Office announced a slew of weak macroeconomic data as it saw industrial output grow by 4.9% year on year in October. That is the weakest annual pace since August 2024, compared with a 6.5% rise in September. It also was lower than a 5.5% increase that was forecasted. A gauge of consumption, that is retail sales, expanded 2.9% last month, also the worst pace since August last year, and cooled from a 3% rise in September, but still higher than a forecasted gain of 2.8%. We also saw fixed asset investment contracting 1.7% for the first 10 months of the year, steepening from a 0.5% decline in the January to September period. Pharmaceutical giant Pfizer has acquired obesity drug biotech company for $10 billion after a bidding battle with Novo Nordisk. That's a Danish competitor. Pfizer also is planning to sell its remaining stake in BioNTech, the drug developer with which it produced the first licensed COVID-19 vaccine. Nissan announced cuts affecting 87 positions at its European regional office in France as part of CEO Ivan Espinosa's global restructuring and turnaround plan that includes a 15% cut in headcount. The struggling Japanese automaker is working to streamline operations and return to profitability as it grapples with prolonged challenges in key markets such as Europe. Oil prices inched up 1% on Friday, stoked by supply fears following an Ukrainian drone attack on an oil depot in the Black Sea port of Novorossiysk. Brent crude futures rose to $63.67 a barrel earlier this morning. Ghana's Finance Minister Cassiel Atuforson said yesterday at a budget presentation to Parliament that the economy has rebounded from its worst crisis in a generation and set for sustained growth in 2026 as investor confidence returns. He added that fiscal reforms and prudent policies have enabled the country to turn the corner, projecting real GDP growth of at least 4.8% in 2026. The International Monetary Fund is reviewing the viability of Senegal's financing strategy as it finalizes an agreement on reforms to underpin a new program. IMF officials have completed a mission to Dakar without outlining a new support package. That was after the previous one was suspended following findings of debt misreporting. And in Nigeria, traders are buying the dip as equities sank following the announced hike in capital gains tax. The basis for the tax was clarified as legislators push for the tax to be reviewed or moved further back. The dominant concern that the new CGT would not be applied on a historical cost basis removed some of the overhang of uncertainty that had contributed to the recent volatility and flight to safety. With many budget performance targets widely missed in Nigeria, like crude oil production levels, lower oil prices, and on top of that, the high debt service obligations, all this has further thinned down fiscal buffers and driven fresh pressures to find more revenues, recognizing the trade-off impacting investor confidence as the government seeks optimal and balanced outcomes. The bounce back in sentiment suggests a market resilience as Wale Edun, Minister of Finance and Coordinating Minister for the Economy, assured stakeholders that the federal government remains committed to ongoing consultation with the market. The investor unease may have calmed, but the government must still find how to expand fiscal buffers at a time when the predominant view is that the populace and business have seen wallets eroded by inflation and still high interest rates. On Monday, we will get Nigeria's October inflation read. Nigeria's annual inflation rate eased for the sixth month to 18.02% in September 2025, also marking the softest reading since May 2022. But the government had targeted a 15% inflation rate this year. Analysts project 17.54% inflation read. That's on Monday for the October print. And there are the familiar factors like exchange rate stability, food price dynamics, the impact of monetary tightening, liquidity and money supply growth, and the PMS fuel price situation, all these impacting price pressures. In another about turn, which could support lower price pressures, Nigeria halted plans to impose a 15% tariff on fuel imports, bringing some relief to the sector. The next action on interest rates by the MPC could depend on Monday's inflation data as the central bank progresses on easing, possibly pausing to watch the inflation trajectory. Asian shares on the back foot, tracking Wall Street's tumble to one of its worst days since April as AI superstar stocks kept dropping on valuation worries. South Korea's Kospi led the regional decline, falling 3.2% amid the global tech sell-off. Samsung Electronics was down 4.1%, SK Hynix down 6.4%, while LG Energy Solutions also sank 3.7%. Well, that's it on this episode of Global Business Insights. Do enjoy your weekend. This is Bode Oshosami. Bye-bye.